Just did a podcast with a 28-year-old that has $750 million of assets under management in the real estate space. And he goes through the exact process of what he does to find deals, manage deals, and also build his firm from zero to almost $1 billion of real estate under management before 30 years old. Hope you enjoy. Hi, everyone. Welcome to the Capital Raiser Show, Season 5, powered by the Family Office Club. I'm your host, Weston Walker, and we interview only the best investment managers and entrepreneurs. Shout out to our sponsors, the Family Office Club, Capitalist Pro, and Invest Next. Today we have Rob Beardsley, who's in his late 20s, and he's built his firm to about $750 million of multifamily acquisitions. Rob, welcome to the show.
Thanks for having me.
Yeah, of course. So you started your firm in college, I believe, and you scaled it to $750 million of assets under management in a span of under 10 years. So could you tell us a little bit about your backstory in scaling your firm?
Yeah, so I grew up in a real estate family, so I definitely had a leg up there. My parents were residential brokers back in Silicon Valley, California. But really, we had no experience on the commercial side of things, or on the multifamily side of things, or even on the buy and hold rental side of things. Everything that my parents were involved in was brokerage, or it was construction, or fix and flips. And so the idea of real estate as a investment was kind of a foreign concept, but I was very attracted to the investment side of the business, not necessarily to the transactions or even to the sticks and bricks of it. And I really saw multifamily as an amazing evolution from the single family world because it has that more corporate, institutional, long-term compatibility, which resonated with me a lot because I knew that I wanted to build something that would be kind of paying dividends over time rather than just chasing a check now or chasing a closing now and really building something long term. So that's what really attracted me as early as kind of going to college, and then what ultimately led to my forming Lone Star Capital while in school and then dropping out.
Awesome. And where did you go to school?
Carnegie Mellon.
Carnegie. Yeah, so take us through your first few deals. Usually people start in, say, the multifamily space like you did, and they give away equity to partners. Maybe they, have to find their way to get a piece of a deal and just building their track record. So take us through your kind of building the track record phase.
Yeah, it takes a very long time to build a track record, and that can be frustrating at times, but it's really a wonderful, you know, even without a track record, it's good to be on the track and to be building it over time. And so that's the mindset that I had going into the business. I knew that I wasn't going to get rich off the first deal or even the first 10 and or even the first 20. And so that's totally fine because you're building for a greater purpose and every win stacks on top of each other. It's not like you start from zero every single January, right? The wins from the year before continue to stack on top of each other. So uh, I think kind of your mindset is the same where giving away equity, it's not embarrassing or it's not a bad thing or anything of that sort. And so when you get started, you really just need to get wins and get the experience however you can get it, whether it's by working for another company or by doing your own deal, but maybe it's your own deal only really in name, but because really you're giving away so many pieces of the pie in order to actually get the deal done, and that's perfectly fine too. And so that I would say is somewhat how our first few deals looked. Obviously, we did not have the track record, did not have the capital, did not have the experience. And so when it came to lenders, we had to get help there in terms of loan guarantors. We needed a property management partner. We needed capital partners to help us raise the equity. And so those are the main components of a deal. And, I kind of brushed through those, but each one individually is a really, really big thing to take on. And so it's taken years to go from kind of outsourcing or bringing on partners for almost everything to then bit by bit, it's you're starting to build the in-house capabilities to where we brought property management in-house, bring construction management in-house. We're able to sign on our own loans. We're able to raise capital more effectively from our own investors and our own network rather than relying on external capital partners, which we still do very much work with a lot of fund managers and co-GPs to help raise capital. But it's a goal kind of in the back of our minds that every deal we want to kind of increase the amount that we're raising ourselves rather than just continuing to partner with external fund managers.
Yeah, and it's more efficient to do it that way. I mean, when you started, you probably just had to, send cold emails out and ask for referrals and do all that kind of stuff. So take us through the first, how did you find the first few deals and where did you raise the capital from? How did you go about raising the funds for those deals?
Yeah, so finding deals, I would say there's two ways to look at it. There are amazing deals out there that you can find and that you can kind of take the time to build relationships or creative ways to, find a seller who wasn't going to list through a broker and all this sorts of stuff. But unfortunately, those opportunities rarely exist in the 10 million plus multifamily space. And from the very beginning, we started acquiring deals in that space. And so there's just not that much opportunity to create a ton of value through the acquisition process because the vast majority of deals are done through national brokers. So it's very, very difficult to break into that space when you're getting started. And even if you have a ton of experience, you've been doing deals for years and you have a long track record and you've got a great team, you have experience, when you do want to break in and start buying those deals that are listed by Newmark and CBRE and Berkadia and they're 10, 20, $40 million deals, it's very, very difficult. You're competing against very big companies that have a lot of experience. So there's really only a few ways to stand out. You can have better price or you can have better terms. And also kind of through those two elements or kind of embedded throughout the whole offer is essentially your credibility and the likelihood of your closing. So when you're not known and when you're new, you don't bring the strength of certainty of close to the table. It's very difficult to actually have better terms because the big boys, they have got all their partners lined up. They can close in 30 days. They could maybe even close all cash if they want to in less time. When you're getting started, for us, the first few deals, it took us months and months and months to raise the capital. That's not attractive for a seller. So it's kind of difficult to get your foot in the door. You can kind of overpromise and underdeliver, and you could say, yeah, I'm going to close in 60 days, but if I can't, give me an extension. So there was a whole lot of negotiating, a whole lot of begging, a whole lot of desperation. It's really not fun times, and I'm grateful to be over those times. But there's really no, in my opinion at least, when it comes to this game, there's no kind of secret key or magic sauce or anything like that. You just kind of have to power through it brute force and and take some gambles.
Yeah, and you started off by taking those gambles, and now it seems like you're attracting capital with your marketing, with your books, and those things. So take us through, I guess, your first few hires at the firm. You have this in-house team now. You started yourself with a couple partners, and one was kind of senior, so you leveraged his track record and his experience in the multifamily space. So take us through those first kind of partnership phases, and then your first hires at the firm.
Yeah, so when it comes to hires, we our first hire was on the acquisition side, and that's very common that you see with multifamily companies because that's the first task that is the most repetitive and hireable. Because when you're small and you're just getting started, you don't have a big portfolio to asset manage. So there's not a ton of asset management work. Like you're not producing 20 investor reports every month and things like that. So you don't really need to hire anyone to do that sort of stuff yet. You can do that amongst, yourself or with your partners, what have you. But acquisitions kind of from the get-go, because even if you have a portfolio of none, but you're looking to grow, you need to do acquisitions. And with acquisitions comes underwriting a lot of deals. You need to do a lot of analysis. You need to talk to a lot of brokers, shake the trees, see what comes down, and, tour deals, bid on deals, negotiate. So there's a lot of work there, even from the very beginning. And so that was our first hire. And from there, as we started to buy a couple deals, then it started to make sense to actually build out the asset management side of things. So once you do have quite a few investors and quite a few investments, then it can make sense to invest in starting to build out the asset management department. And so today we have 3 asset managers across 22 properties, which is a pretty nice kind of share where people aren't, I mean, there's a lot going on, but they're not too overwhelmed by the number of properties that each of them has. And it allows us to continue to acquire, because you don't want to be at full capacity and then buy a new deal and then it kind of all falls apart because you don't have the capacity to continue to expand. So we'll be continuing to scale up and hire more people on the operations side, which is actually very different than the acquisition side of the business, because like I said, the acquisition side might be the very first hire, but it's also kind of like the last hire, because you don't really need to continue to scale your acquisitions department proportionally with your portfolio. Because, I mean, this year we haven't even bought a single deal, right? We have 700 million in assets, but we haven't done any acquisitions. So, but even when you're doing no acquisitions, your operations stays very busy. So I'm excited about the scalability of the acquisitions department and that we don't have to keep on hiring and hiring. Some people kind of choose to do that. And I think that's just getting away from being lean. And we want to stay lean. I mean, we have a small team with about 10 of us here in New York, and then we've got um, about 160-ish people down in Texas if you include the on-site staff. So that's maybe about 20 corporate employees down in Texas for operations. So yeah, staying lean, in my opinion, is the name of the game, because property management is just not a profitable business. So you got to really find ways to make money on the acquisition side and staying lean.
Yeah, and it's not profitable, but you do get that control, and that's the main reason why operators bring it in-house. So take us through your underwriting process. You wrote a book on underwriting multifamily investments, and that seems to be like your expertise. That's your niche. You're the king of underwriting. So take us through your process for underwriting and why you've kind of taken a pause on buying deals in 2025.
Sure. Yeah, those are great questions. So the process on underwriting is fascinating because, I published that book, which was and is a great success. A lot of people have bought the book, read the book, and have discovered about us through that book, The Definitive Guide to Underwriting Multifamily Acquisitions. But at this point, that book has been published for just over 5 years. So it feels like a lifetime ago. And so much has changed. Our philosophies have changed. Our sophistication has changed. Everything, just we continue to improve the process every day. So that's why I'm excited to kind of share the latest and greatest of our process. We built a model from scratch going back over like 8 years ago. And so that model we made available for free on our website, and it's been downloaded over 20,000 times. And we keep on just making improvements to that model every single week, it feels like. And so people keep coming back and downloading the new version and things like that. And so the big things that I'm excited about is that we've added a budget template right into the model. So that way we're trying to eliminate that disconnect between underwriting and budgeting, because really they're one and the same. And the reason why this disconnect exists is just because in the multifamily investment business, there's just this constant disconnect between essentially the ownership side of the business and the management side of the business. Because, like you mentioned, it's really valuable, even though it's not profitable, it's really valuable to bring property management in house to kind of marry the two departments. And nevertheless, most people use third party management. So the ownership's got their pro forma, they've got their underwriting, and then the property management company that they hire, they've got their budget and they've got their ways of doing things and their ways of accounting. So they've got their financials and this and that. And it's very hard to marry the two. And so we brought property management in house in 2021. But even still, even with in-house management, we were not integrated. We were not married. We were not one company. It still very much felt like the ownership versus management. And that was a cultural problem. That was a structural problem. And I had to make a change. So last year, I went down to Houston and I lived in Houston for 6 months at one of our properties to really integrate the two sides of the business, collapse it, and just make it one company. And that's a kind of a big structural cultural shift, which kind of trickles all the way down to the fact that we're doing the budgets all together as one company. There's not two sides. There's not, left arm, right arm. It's just one initiative. And we're actually able to kind of everyone top to bottom, from the acquisitions to the asset management to the property management, we all can put together a budget together, one team. And that can be done very, very early on in the underwriting process before we've even, bid on the property or secured the asset.
Interesting, yeah. And you built your multifamily underwriting model from scratch. You see a lot of guys, they use a model that's off the shelf. They don't know the ins and outs of that model, and they haven't really dug deep into it. So why do you suggest building a model yourself, or going to use yours, for example? But it might be a really good learning experience to build something from scratch.
Yeah, I think you answered it right there. There's a few benefits. Knowing the model in and out is a benefit, and it's very difficult to know a model in and out unless you've built it. So I don't even necessarily recommend that people, bet their life on our model if you're planning on underwriting deals every single day and bidding on properties every single day, because there's just so much value in, sure, download a bunch of models, take them apart, see what you like, see what you don't like, see how the formulas work, and then, improve upon it. And so that's kind of what we do, and we're learning every day. And I've broken our model and rebuilt it 1,000 times. And so I think that there's really, like you said, there's no other way. Oh, no better way to learn than by going through that process.
Absolutely. Yeah, and you wrote another book, Raising Debt and Equity for Real Estate. Could you tell us a little bit about that?
Yeah, so that I kind of view as a sequel to the first book, because the first book is about obviously underwriting multifamily acquisitions. So it's getting into the number side of things and the analysis side. But the step two, in my opinion, is now that you've got the deal and you've got the deal analyzed, the next step is, of course, putting the capital structure together, which is just essentially the debt and the equity, which sounds simple, but there's actually major things that go into each. On the debt side, it's all about figuring out. I mean, of course, there's some relationships involved and there's some kind of negotiation involved and strategy, but it's mainly about kind of figuring out what your strategy is, and then making sure that your strategy, your essentially your investment goal, the deal you're actually looking to buy, and your capital structure, meaning your debt, are all in alignment. Because when you have when you're not in alignment there, that's when you can get yourself into trouble. For example, if you have, let's say, a long-term investment strategy, but then you use short-term debt, or if you have, or the opposite, right? If you're looking to kind of do a turnaround play, but you don't have the right debt structure to match that, and you've got prepayment penalties and all sorts of things like that. So really becoming an expert on debt is super important. So the second book, like you said, structuring and raising debt and equity, is all about all the different loan structures and programs, and how to match things up with the business plan. And then on the equity side, of course, I talk about raising money and building relationships and kind of all that stuff, which I think a lot of people talk about. So it's not a terribly unique piece of content there on the equity side, but nonetheless, it's really the most important part of our business, because we wouldn't be anywhere without our investors.
No, for sure. Yeah, and you see a lot of groups right now raising pref equity, and you talk about that in your book as well. So why pref equity? You see groups offering, say, 14, 15% returns over a 2-year period. So yeah, it's basically being infused into these deals. Like, what are you seeing in the market currently with these properties and with these deals?
Yeah, so I mean, I would say most of the time, especially in this environment where we are right now in the market, the sponsors that are raising pref equity, they're raising that equity for their own deals. So it's essentially like a capital call, but it's a capital call that is structured and kind of has more debt-like terms to the structure. And it's also available to the public, right? Whereas a capital call is usually being made to basically the investors that are in the deal already. Like, you put 100 grand into the deal needs to pay down the loan, or needs to buy more time with the lender, or needs money to fix it up or whatever. And so you need to go back to investors and say, hey, you put in 100, I need 25, another 25 from you, or something like that, right? But in this case, with a preferred equity capital call, if you will, they don't have to go back to the original investors. The sponsor can basically put it out to their broader network and raise the capital from anybody. So that provides, greater likelihood of success on raising the funds that you need. Because if you are just limiting yourself to the existing investors, that makes it harder, right? Existing investors might be tapped out, they might be unhappy with the deal, and so there's a lot of issues there. But what I would also say is these preferred equity raises are really challenging when you analyze the numbers. A lot of the times when you're looking at these deals, these is really a bad deal for investors. And I really, for the most part, do not recommend these deals because they're offering this out of desperation, and they're offering it because they have no other option. That's what desperation is. So people unfortunately are not sophisticated enough to fully understand the risk that they're taking. So while they're being offered a 14% return in 2 years or something like that, they might think it's attractive, but the actual amount of risk they're taking is not commensurate with what the projected return is, and let alone what it means for the existing equity in the deal, which in many cases on paper is wiped out. And so it's unclear whether enough time will really save the original equity, or even if it's going to be enough time or enough equity there in total to really pay back the pref equity. So it's you're playing the game of lender, and what do lenders want? Lenders want equity cushion, and a safe bet for a lender is to lend at 60% loan to value, because that way they have 40% equity cushion. Similarly, this pref equity stuff, it's just another form of lending, but a lot of times this pref equity is coming in at 100% of the value or even greater. So what lender would lend in excess of the value of the property? It's like if I came to you and I said, I've got this property worth $1 million. Do you want to lend me 1.5 million? And so that's, any sophisticated lender would not do that.
Yeah, and it's a kind of a combination of over leverage and the projected exit cap rate, ratio. Just too high of a price that they're betting on the appreciation later. So yeah, give us like what are you seeing in the market today? Why are you taking a pause on buying deals?
So it's definitely not due to a lack of effort. We're looking at deals every day. We're staying very active, but it's just been a tough year as far as valuations relative to interest rates, as well as a as well as what is being sold, right? So first of all, transaction activity is way down. So there's much less coming for sale, and what is coming for sale is also, generally speaking, of a limited um, type of deal. So what we're seeing in our markets, which mainly at the moment is Dallas and Houston, there's transaction activity is down, and the majority of what is being sold are newer assets, because people who own older assets, which really, I mean, we love newer assets. Everybody wants to own newer deals in nicer locations. Those are the best to own. Those are a dream to manage, all that stuff. But really, our bread and butter are more workforce housing type deals, which are more like 80s vintage product, because they're old enough to where there's usually you can get paid for the risk. You can do renovations. You can fix the property up. You can put in the work to be a hands-on manager and get a good return. But unfortunately, those deals are not really being sold right now because they are worth so much less than before. Nobody really wants to sell and take a loss. So all you see that's going for sale are these newer assets, which people bought at less inflated valuations, or they bought a long time ago. So they're actually happy to sell today because they're not actually looking too bad on their exit. But the problem is, because there's a limited amount of sales and they're clustered in kind of the newer vintage, better located uh, class of properties, there's just a ton of buyers going after the select number of properties. So the competition is very, very high. So we're competing against Cortland and Greystar and people that we just frankly cannot outcompete because they have better reputations. They're willing to pay a higher price, and even forget the price, they're just willing to close in 30 days, and they're willing to put $1 million hard day one. So it's very tough to compete with these sorts of buyers, which is why we would love to be buying the 80s deals so that we can stay away from the big boy competition, but there's just nothing for sale. So that's the predicament that we're in right now. Of course, through the brute force of money, anything is possible. So you could theoretically buy a deal today. I mean, it's definitely possible. There are still people who are buying deals today, but what we're seeing is people just being kind of deaf to the market and just paying whatever it takes to buy a deal for the sake of buying a deal. And trust me, we are very motivated to buy a deal, just like everybody else. We make acquisition fees. We put ourselves in a position to add another property in the portfolio. It's mission critical for us to buy a deal. So you have to really look at why are we not buying a deal, and how can another group that is looking at the same exact deals as us buy. something isn't adding up. So that's kind of how I see it right now when it comes to the market.
Yeah, and you guys have bought 80s deals. You have an average 30% IRR over your track record, which is amazing. And you're looking at the newer deals. So when do you guys see yourself getting into those newer assets? And how does your equity and I guess debt partners change on those deals? Are you going to move more into family offices, institutional? I know you've already raised from family offices, but will you guys be a more institutional firm in the future? Like what's the plan there?
So last year in 2024, we were actually very fortunate. We bought 5 deals in total, and 3 of them were early 2000s vintage Class B assets, like really good, awesome assets, good locations. And then we also bought a couple of older deals as well. And so we definitely have already been buying some newer deals. It's definitely what I'd prefer to be buying. Like I said, just because of the lower risk of the deals and the easier they are to manage. But I don't know. I mean, with the competition, it's very tough to say when we would be able to win one of these deals. It would just have to be either smaller or it'd have to be a little bit older, something that the global liquidity isn't chasing after as hard. So we'll see if and when that happens. I think that there yeah, I really don't know. I keep saying, yeah, I think, in a year or in 6 months or something, rates are going to come down or prices are going to do this or that. But what I'm very confident in is that prices are not going to come down in any substantial way. We saw the bottom in prices when it comes to the newer vintage assets a year ago, or even more than a year ago. What's interesting to track are these 80s and 70s vintage deals because, as you can probably imagine, nobody really wants to buy a 70s deal today. So the question is just how low can the prices go on 70s deals until someone says, you know what, I I'll buy it because nobody else will, and so I can get a cheap enough price to actually justify the risk of owning a 70s deal. Because just because a deal is built in the 70s doesn't mean it's worthless. But the market is kind of some people in the market are treating them as worthless, right? Just look at how hard it is to raise capital for a 70s deal. It's very, very difficult. Investors don't want to invest in it. So at some point, we'll see if those prices keep coming down to where it does make sense to buy 70s deals. I've told Brad, our director of acquisitions, that we absolutely are interested in buying 70s deals as long as we buy it cheap enough and as long as it's small enough that it's only about a $12 million raise, because I don't want to go and do a $20-25 million raise on a 70s deal because I don't want to ruin my life.
Yeah, absolutely. Because it's tough to, I mean, it might be I talked to a guy yesterday. He's like, well, if the numbers don't work on a 70s deal, I'm just doing a charity project. You know what I mean? So the numbers have to work on that. And we're seeing in the Sunbelt markets today a big supply demand issue. A lot of development has started in 2021, 22 when the interest rates were low, and they're just now coming online, which is causing lots of supply in the market. So is that pushing your 70s, 80s deals the rents down, or is that kind of completely separate from those?
It absolutely is. Yeah, it's definitely a myth that new supply only impacts newer assets. Class A, B, C, they're all impacted by new supply. It trickles all throughout the market. I would say that depending on the location and the proximity of the supply and all that, there's variations of impact, but you definitely have seen softening rents, softening occupancy, and things like that when it comes to the older assets.
Yeah, absolutely. And do you guys see yourself moving into different markets in the future? You focused on Dallas in the past. Maybe you'll move to Phoenix or some markets in Florida.
Yeah, absolutely. Yeah, we are actively looking to break into the Phoenix market. So, yeah, we think we'll probably have our first Phoenix acquisition in 2026. We really like Phoenix. So does everybody else. But Phoenix has actually been kind of beat up over the last couple of years because it went up so much so fast that it kind of fell pretty hard, and it was the most built apartment market in the country. So, like you said, it's dealing with a ton of supply issues, and that we see those supply issues kind of working themselves out all the way through the end of 2026, really. So there's no rush, in my opinion, to get into Phoenix. There's really not much transaction activity going on there, but we're going to be ready hopefully when the timing is right because long term, we still very much believe in Phoenix. We think that that market has a ton of legs. It's a big market, it's a fast growing market. So those are the types of markets that we want to be in. We only want to be in kind of the top 15, 20 largest markets in the country that have the right growth dynamics for long term holds.
Absolutely. Yeah, and you guys are headquartered in New York, but you're buying deals out of state. Is there a strategic advantage to being headquartered in New York and then having an office in Texas?
Yeah, I think so. I think that New York, for all of its faults and kind of difficulties, it remains the number one labor pool probably in the world. If you want to hire a billion, engineers or coders or lawyers or finance people or real estate people, probably the best place to do it is here. So I think we've got an amazing team in part due to the fact that we're here in New York. And there's definitely some opportunities when it comes to events and meeting investors and things like that. We wouldn't have raised, we probably, if we weren't in New York, we probably would have at this point raised maybe half as much capital. So we've raised over 200 million in equity and, maybe it'd be only like 120. So I think there's definite benefits of being in New York from a investor and talent perspective.
Yeah, and you guys host some events in New York. So tell us about the events you have coming up.
Yeah, it's super exciting. So our flagship event every year is called the LSC Summit. So it's just Lone Star Capital Summit, but it's an event we put on every year in around September, October time. And our office is here in the One World Trade Center. So we host in the beautiful event space, 360-degree view event space in the One World Trade Center. And we invite all of our kind of top uh, network in New York and from around the country that are lenders, investors from family offices to funds, institutional investors, and high net worth individuals. And then we also invite other sponsors that are in mobile home parks and self storage, in development, in retail. So we kind of bring more people than just, we're not the only show there, right? We're not trying to make it the Lone Star Show, even though that's the name, but we're trying to basically bring together the best of our network from a sponsor perspective, from an capital perspective, and really just have a meeting of the minds. And really, it's a huge, huge emphasis on networking. I would say one of the most valuable things that we do is we do a 90-minute speed networking session where everyone gets 10 9-minute meetings and we actually hand pick the meetings for every single person. So we spend the weekend
Mm.
before the event just literally handpicking. That's why our events by application only, because we do research on everyone, we know everyone who's coming, and then we try to thoughtfully match make everybody so that people actually leave with real value, because we know how expensive we go to conferences ourselves, obviously, right? So we know how expensive it is to take the time and the money to travel somewhere, to buy the tickets and do this and that. And we want to get an ROI. So we want to make sure people get ROIs when they come to our event as well.
Yeah, and most events aren't tailored like that. So that's really awesome that you guys are doing that. And people usually look for, say, a ratio at the event to from sponsors to investors. Maybe they want to raise capital and they want a higher ratio of investors. So you mentioned you have institutions, family offices, high net worths, and sponsors as well. What's kind of the ratio there?
Yeah, I would say the ratio is going to be about maybe 20% sponsor, 80% capital.
That's awesome. Yeah, and then speaking of capital, you guys work with a lot of fund managers, people that raise money as a limited partner to come into your deals. So could you explain a little bit more how you work with fund managers?
Sure. Yeah. So fund managers, there's different ways to describe them. There's different names, right? Our business is always changing. So we used to do co-GP partnerships. We don't really do too much of those anymore because the market has shifted in favor of the new fund to fund structure, whereby our partners will now come to us and they'll say, "Hey, I've got my network of investors. We all want to invest with you," and so they'll form a special purpose vehicle that will pool together, let's say, 1 million or 2 million or something like that. And then that SPV will invest as a single check investor into our deal. And that will get them access to a preferred share class with us, where, for example, we have a $1 million minimum for our Class C investment. tranche, and that gives them a preferential uh, waterfall split of the profits and things like that. And so then they're able to take that enhanced economics and share it with investors while also taking a piece for themselves as the fund manager of the fund to fund vehicle. And so they're able to charge fees to cover the fund costs and things like that, and then earn a promote from the enhanced economics to the fund. So their investors win, they win, and then we win because we're able to raise capital at bigger chunks at a time, which obviously we're paying more for it, but we're willing to do that because it's for the greater good of getting a bigger deal closed. And, if we're raising $20 million, we might raise, let's say, up to $10 million from our own investors and then bring in the other half from fund managers who might bring us, one, two, even $5 million at a time.
Yeah, and do you guys handle some of the work that the fund managers do, say sending out K1s, sending out reports, and the portal? What do you guys provide in terms of back office for the fund managers?
Yeah, so we partner with TribeVest, and TribeVest we don't make our fund managers use TribeVest. It's just an option that we share. And so TribeVest is our back office partner that does all the fund and legal formation. They do the accounting, they do the K1s, they do the distributions, they have a portal. So all of those resources are available for our fund managers. Many of our fund managers go that route. Some of them actually have their own in-house legal or other capabilities that they do themselves or with a different partner. So it just kind of depends on the relationship. But I think we try to have a balanced approach when it comes to fund managers because we don't want to dictate and do all the work for them. And we certainly don't want to create extra work for ourselves. We want to get the value of the partnership. But at the same time, we obviously want to make it as seamless as possible for our partners to work with us, so that they have a good experience.
Of course. Yeah, and you guys have built your firm off of multifamily investing. Do you guys see yourself expanding into other asset types in the future?
No, never.
Never. What if
I
what if
hope
the
not.
price is too compressed? There's too much competition for deals. Will you guys still be buying multifamily?
I hope so. I hope so. Either if I'm doing something other than multifamily, that means something went really wrong or something went really right. And if something's going really right, meaning we're so successful and we're crushing it and we've got an amazing portfolio and I'm sitting around bored, I need the number one thing I should do is restrain myself from action because boredom is perfectly okay. Money is money. You don't need to be making money while not being bored. Making money while being bored is just fine. So the way that you kind of go broke is when you are bored and you get away from your skill set and you start doing other types of deals, doing other strategies and whatnot, and that's when you can get into trouble. So I really hope we just keep it simple and stick to multifamily because multifamily is a very boring and dumb asset class. It's not like data centers. It's not like a startup in terms of AI. People are going to always need a place to live. Yes, to your point, the prices are not what they used to be. Multifamily is not a cottage industry anymore. It is an institutionally owned asset class where you have billions of dollars of allocation from sovereigns, from pensions, from endowments, from high net worth individuals. There's an incredible amount of capital in the multifamily space. So we're never going to see the amazing returns and the cap rate spreads of days before. So yeah, multifamily is not this amazing opportunity that it used to be, but it's a institutional asset class that's not going anywhere. So I think I hope at least, it's investable for decades to come.
Absolutely. Yeah, and that's when you see people get distracted in other asset class. Maybe they might move into self-storage or senior living or industrial parks, which is completely different. You're dealing with maybe one or two tenants instead of hundreds at a time, and you're diversified across the tenant base. So, what are the plans for the future of the firm? Give me the broad vision and the big goals ahead.
Yeah, so the vision is to expand into Phoenix, like we covered earlier. That's really exciting because our investors have been wanting us to be in more markets for a long time. Because it's not prudent for an investor to invest all their money with us and all that money going to Houston multifamily, right? So diversification is really important, but at the same time, I have to balance that because we're a specialist company, right? So we're not this wealth manager where people can come and park their retirement savings with us and we're just going to put it in a diversified basket of goods, right? We are a specialist. We invest in multifamily. Right now, it's just multifamily in Texas. So we're a specialist, and I think that's an advantage because that allows us to do what we do really well. So I want to thoughtfully, carefully grow and expand our expertise while not diluting our effectiveness. So when we expand into Phoenix, we have to become experts in Phoenix. We have to have the boots on the ground. We have to have the scale. So all these things take a long time. So that's why I want to expand into a new market roughly every 5 years. And in the end, not be in too many markets because I mean, really the grand vision is only to own about 50 to 100 properties, and we already own 22, and be in maybe 3 to 5 markets and have around, I would say, $3 to $5 billion in assets under management. That's the master plan. It's not, it's ambitious, but I'm not trying to take over the world.
Yeah, and it's very specialized. So you guys have done syndications deal by deal in the past. Do you guys see yourself, you know, keep doing that strategy in the future, or are you planning on launching a fund that's diversified across, Texas, Phoenix, and the other markets that you're investing into?
Yeah, I don't want to say never, because a fund is really wonderful. A fund structure is really great for investors, and it's also really great for the sponsor. So for investors, a fund is really amazing because with one check, people can get exposure to hopefully many assets and hopefully across different strategies and geographies. And that's truly very beneficial because it is difficult for investors to achieve diversification across private real estate because of the minimums. The minimums are very high. Our investment minimum is 50K. For many funds, it's 100, 250, 500, a million, even $5 million for some institutional funds. So it's very tough to get diversification with those minimums. So if you can invest into a fund, that can really help. And then for us as the sponsor, a fund is great because we're not under the gun constantly fundraising for every single deal, and that has its benefits too. The problem with funds though is it's really 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 hard to raise. And so kind of from my experience and from my observations and with talking to people who have a lot of experience in this business, I think that fundraising when it comes to deal by deal versus a fund, I think you can raise about 10% in a fund as what you could raise on a deal by deal. So if you have a deal by deal business model and you can raise 100 million a year, you can maybe raise $10 million for a fund. That's how hard it is to raise for a fund. So for people thinking, yeah, I'm going to go out and do a fund, good luck. It's really 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 hard to raise for a fund. So that's why, although there's so many benefits for a fund, that's why we're going to stick to deal by deal for I think a very long time.
Yeah, it's just much easier to scale. And fun fact, I talked with the owner of the Phoenix Suns who has $3 billion of his own real estate, Class A properties in Phoenix. And he still raises deal by deal. He doesn't take money as a fund. And he recently had a family office put $300 million into one singular development, huge development deal that they're doing in Phoenix, which is crazy that he's still doing syndications and it's easier to raise money that way. So with all the knowledge you have now, Rob, you're in your late 20s, you bought almost $1 billion worth of multifamily. If you were starting your firm over today, maybe for those people that are just starting out, how would you go about starting your firm, raising capital, and finding deals?
Yeah, I think that it's always easy to look back and wish things were better or different, or say that, oh, I would have done it differently. But if I am allowed to go back in time, I would definitely wish that I had a more holistic understanding of the business and was in a way more hands-on. And when I say that, I'm kind of specifically talking about operations, accounting, really just every part of the business. I want, I going back, I should have understood more parts of the business. I should have looked at the K1 process and what does it actually mean and take to file the partnership returns and distribute the K1s, and what goes into that, and what are the problems, from year to year trial balances and all that sort of stuff. So, learning how to do those things almost yourself to then outsource it. And so I think yeah, like I said, when it comes to taxes, accounting, operations, construction, getting into all that stuff is super critical. And, it's unfortunate because honestly, I didn't get into the business wanting to do those things. I didn't get into the business wanting to write books or do podcasts or talk to
Yeah, I don't think
investors,
anyone does.
right? And I most certainly didn't get into the business to do accounting. But now I do a ton of accounting. I'm talking and thinking about taxes. I'm talking and thinking about construction, strategy, hiring. There's just so much that goes into business that you take for granted because you think, oh, well, I'm just going to go buy deals, right? But that's not actually what you're doing. What you're doing is starting an operating business that has all these elements that are incredibly complicated. And business is the most difficult game in the world. And uh, it just takes really being on the ball.
Takes more than you think. Yeah, because
Yes.
I mean, multifamily, it just seems like a basic business. You go buy a deal, you go buy a deal and do the construction, but there's really different parts and different departments. I talked with a guy yesterday from Beverly Hills and he bought $1 billion of real estate in the past 35 years. You're almost there in about 10 years. So it's funny, but he built whole departments in accounting and construction and property management, just starting it from scratch and getting his hands dirty in those business models. So yeah, Rob, if any investors or partners or sponsors are interested in partnering or investing in your deals, what's the best way for them to get a hold of you?
The best way to connect and learn more about us is on our website. You can go to lscre.com. On our website, we've got some great free resources like the underwriting model we talked about, links to the books that I've published, and of course, more information about getting in touch with us to discuss next steps and getting to know each other.
Awesome. Thanks for coming on, Rob. Really
Yeah,
appreciate
thanks
it.
for having me.